There is no correlation between past performance and future performance.
None.
None.
Now that was groundbreaking for me. It wasn't until I first started reading academic research and then found dimensional funds that anybody had ever posed it that way. In fact, the way the sales training in the industry that I was exposed to early on in my career said was, well, past performance is no indicator of future, but it's the best indicator we got. Let's look at these Morningstar reports. Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am founder and CEO of Sound Financial Group and your co-host for Your Business, Your Wealth. I am joined by Cory, finding the best guests for this podcast, Shepherd. Cory, I am so excited about our guest today. I'm going to just sit back, let you introduce him, and I will be bombing in questions along the way.
Well, so our guest is Dr. Stefan Sharkansky, and it's kind of a funny story how we met and got to have a conversation. We'll talk about that in just a moment. But Dr. Sharkansky holds an MS, a master's in computer science from Stanford University. I hope you guys have heard of it. And a PhD in statistics from the University of Washington. He's also the founder of personalfund.com, a research site dedicated to helping investors identify the full range of fees and costs embedded in their mutual funds. And that's going to be the topic of a lot of our conversation today. So, Dr. Sharkansky, welcome to Your Business, Your Wealth.
Glad to be here. Thank you very much for inviting me on.
Yeah, it's our pleasure. And it was so fun for us to meet. So we've been subscribers of personalfund.com for many years. And I received a customer survey, filled it out via email, and got a follow-up from Dr. Sharkansky. And he said, it looks like I'm in your backyard here in the Seattle area, and maybe we could have a chat to follow up. And I'm like, well, actually, I live in Chicago now. That might be hard, but we can certainly have a Zoom meeting and chat. And it was amazing to find out that this resource that we've been using for so many years to help our clients is really just right in our backyard. So it's great to have you as a neighbor, and to give folks just an idea of where you've come from in your career, which has been a lot of different arenas, from missile systems to internet chat and software development and financial markets data. Now, could you tell us about your path to starting personalfund.com?
Oh gosh, well, you remind me about internet chat. This was a company I started in the very, very early phases of the internet boom. We're talking 1994.
Wow. Before internet startups were cool.
Internet, I was one of the first internet startups, actually. And so the idea was to do a commercial version of internet chat, which didn't really exist at the time. You had AOL chat rooms, which were used commercially, and you had all sorts of freeware stuff. And my goal was to create for the internet what the equivalent of an AOL chat room, a more managed, commercializable experience. In any case, that small company, got acquired in 1995. Around the same time that Netscape went public, if anybody is old enough to remember that.
Mm-hmm. Yes.
And so what that left me with is enough of a nest egg that I needed to figure out how am I going to invest my nest egg. And so being the academic-minded sort of person I am, I did a ton of reading and research, everything from popular books on investing for the average person, Personal Finance for Dummies, I think was one of them, all the way up through Journal of Finance research articles. And after reading all this stuff, I simplified what you need to know about investing to this very simple statement: buy and hold a diversified portfolio, minimize your costs and taxes. And that's it.
It's been wonderful having you on the show.
Yeah,
I think that is exactly in alignment with our brand.
So it really is that simple, I learned. And it sounds like that's how you operate in your practice and the advice that you give your clients. And so I set about to create a website as my next venture after I got out of the chat space, to implement that philosophy for the individual investor. And today we've heard of things called robo-advisors, perhaps.
Mm-hmm.
Well, I was going to be the first robo-advisor, basically. I wasn't using that term then, but the term personal fund was what I came up with as your own individualized personal portfolio distinct from a mutual fund. And it was going to be like a robo-advisor, a professionally managed portfolio customized for you, automated to the extent possible to give you the best achievable market returns by minimizing your costs and taxes, et cetera. So it's a fantastic concept. Lots of companies are very successful with it today. Yeah. Unfortunately, when I came up with it, it was 20 years ago. Mm-hmm. And it was so far ahead of the market that nobody knew what to do with it. So anyway, it became impossible to raise enough money to keep the full concept going when the internet bubble collapsed in 2000 or so. But what was the free teaser educational content was the mutual fund cost calculator, which was there to say, hey, this is how you're investing today in your mutual fund. This is how much it costs you to invest in mutual funds. And this is how much money you're losing by paying overinflated fees to mutual fund managers and by losing too much in taxes. You're leaving all this money not only on the table, but you're giving what's on the table to somebody else that's coming out of your own pocket. And so the idea was to show this is how much it's costing you today. This is how much we can save you by managing your own personal fund on our site. Well, when having your own personal fund became impossible for us to implement that, we found that still a lot of people were really interested in looking at our mutual fund calculator because, even though things like expense ratios are fully disclosed and people know to some extent about tax efficiency, even back then, the numbers were really shocking when people added up the actual numbers and how much a 100 basis points of an expense ratio in your mutual fund can eat into your wealth over time. And
it's so fascinating to me that the teaser free content to pull people in ended up becoming the main business of your site.
That's right.
That's pretty amazing. And just so people know where you're coming from, kind of your perspective, or what side of the table you might be on, could you talk just a little bit about what your business model is now, just high level, how the business model of your site works? You get a lot of ads from mutual fund companies, for instance?
Absolutely not. Absolutely not. There's no, the only revenue is subscriptions from customers. That is, it's mostly financial advisors like yourselves who access the information on our site to help them educate their customers.
Well, and if I may, just because I want to bring our audience in, you guys may be talking about something they're not as familiar with yet. And some of you have heard us talk about the embedded costs inside mutual funds. And that embedded cost that's inside mutual funds oftentimes is not fully expressed inside the asset management fee that you would read about, say, in a prospectus, or if you're Googling the mutual fund on Morningstar. Now, we're going to go deeper into that, but I've got one story of talking to a guy who's owned a financial advising firm for over 35 years, like long time this guy's had this business. And I'm on the phone with him, and there was a set of mutual funds that he had taught all his advisors to use, one that everybody in our audience would know. And one of the things I brought up was a personal fund report. And I said to him, I said, you don't realize the underlying costs that are being incurred inside the mutual fund. He says, that's just not accurate. When you're doing those public speaking events or your YouTube videos, you're just causing fear in the investor. It's not necessary. It's not accurate. I said, it's absolutely accurate. He said, I even called this fund company that will remain unnamed and talked to somebody, and they said, absolutely, that's all the cost. So what I had done is I quickly brought up a prospectus for one of the funds. And I said, do you have a prospectus there? He says, yeah. So I pulled it up on my computer. For those of you that don't know, I'm the Control F king. So you hit Control or Command F if you're on a Mac, and you can search any PDF or web page really rapidly. And I went in and showed trading costs in the prospectus. And I said, go to page 14. You're going to see trading costs are paid out of the proceeds of the sale, meaning they sell $1 million worth of Microsoft, and let's say what they net is $998,000. All that's reported is the sale price, but that extra little bit of cost for having made the trades is not in your actual prospectus. And sure enough, he turned to page 14. I directed him the part of the page it was on, and he said, I'm going to call him back. Sure enough, he called back, went like 2 or 3 managers up at the mutual fund company from the call center, and sure enough, they said, oh yeah, that is accurate. Mm-hmm. And then even after that, just being in the industry that long, denying it forever, well, it doesn't matter. They're a good mutual fund company anyway, because they can't change their practices.
Right.
And kind of curious, have you found yourself either, in today's social media world or in person, have folks that get irritated with you on the advisory side who are really, I don't want to say pursuing, but stuck in that active management that mutual fund managers trade a lot and get disturbed with you because you've created a platform that allows disclosure of these extra costs?
That certainly happened when the site first launched. I got a lot of nasty grams from financial advisors who like to actively manage funds. They like selling funds with loads. Mm-hmm. And I got some nasty grams from fund management firms, ones that you would have heard of. Uh-huh. No, this isn't accurate. Our trading costs are so much better than this, that, and the other thing. I haven't gotten many for a while because once people get used to the shock, either they understand the message and they understand the science and they understand the reality of it all, in which case they'll rely on the site, or they're completely offended by the whole thing because it's a legitimate challenge to the way they've been doing business, to the detriment of the individual investor, and they don't engage anymore.
Well, go ahead.
You mentioned something about the trading cost, and this is a really important point. And what you found in the prospectus for the trading costs would be brokerage commissions, presumably, right. And that is a part of it. But there are additional components of trading costs that are there also, and those are bid-ask spreads. Mm-hmm. The price that you sell something at. I mean, you have 2 people in the marketplace. One is selling a block of stock. The other is buying those stocks. Mm-hmm. You've got somebody in the middle, not just the broker charging you a particular commission, but you've got the people at the exchange who are making money off of every transaction. The price there's always a markup between the price that the investor who's selling the shares sells at and the price the other person is buying back. That's the bid spread.
Yep. And which you got to say very clear, it's the bid-ask spread. Right. Because once you learn what it's costing you, you might want to call it the the other.
Yeah, the other thing.
That's exactly right. And those can be quite significant. even more than the commissions that are reported in the supplemental materials to the prospectus.
So you have
and the
brokerage costs,
what's that?
brokerage costs,
Yeah.
the bid-ask spread. What else are investors dealing with?
There's market impact costs. So when you're a mutual fund and you have a very large position you want to buy a large position or sell a large position, that in itself affects the price. It's all a matter of supply and demand. So if you're a big ask mutual fund and you have a large position in some stock you want to get rid of, what's that going to, and you're selling 1 million shares, 2 million shares, however many big position you're going to sell, just putting that amount of inventory on the market is going to necessarily depress the price.
Wow. So fund managers getting in their own way or not being able to get out of their own way is a cost. Just doing what they are going to have to do to run the fund can create some cost. That's
right. Managing the fund actively. Yeah. So all those things together create costs, and it's very hard to measure those directly. But looking at all the data of mutual fund returns as a big data set statistically, you can infer what the average trading cost is for particular types of securities.
Well,
and that's one of the things that I've done in terms of the research studies that we've done and what goes into the site to estimate the transaction costs.
And what would you say, like say your average actively managed mutual fund? In fact, this might be a good question. We're going to come back to the answer to this question. I'm going to take us to commercial break today, Cory. So when we come back,
go for it.
What I want to ask is how much across active managers so these are the managers that are trying to quote unquote beat the market. And so they're trading stocks, what is the average increase in cost to the mutual fund when fully disclosed versus the cost of that same mutual fund, perhaps the way it's marketed in the prospectus or what's present when you look at another third-party tool like Morningstar Online. We're going to be right back after this message from Sound Financial Group. Paul Adams here at Sound Financial Group. Are you curious what you can accomplish with our help? You're here enjoying the show. Our philosophy is helping you increase your effectiveness with money, and now we have a way to help you take another step on your financial journey. We have designed a financial inquiry call for you and the thousands of other listeners of Your Business, Your Wealth. This is a complimentary 15-minute conversation where one of our team members will ask you some key questions, understand your concerns, and if appropriate, schedule a time for further conversation with an advisor. If you look at the episode description, you'll see a link to schedule a call at a time that's least invasive for you. And even if now's not the right time for us to work together, we'll point you toward resources to help you in your financial journey. We always look forward to connecting with our listeners, and we look forward to talking with you soon. Welcome back to Your Business, Your Wealth. I am excited to get the answer to this question. What is the average increase in cost for the actively managed mutual funds that are intentionally trying to outperform the market? And I often give the metaphor of it. It's like a runner trying to run, pulling a parachute. And the harder they run, trying to outperform the market, the more resistance that they create against their actual objective.
Yeah, that's a terrific analogy. I like that. I'll have to remember that. So if you have, the way we measure it is based on the type of assets that the fund holds. So simple example, large cap U.S. stocks. Those are the most efficient those are the funds with those are the kinds of assets with the lowest trading costs because there are so many people in the market is most efficient. But still there's all these components of cost, the market impact, the bid-ask spread, et cetera. So what I've estimated is that for every 100 percentage points of fund turnover is a number that's reported by the mutual fund. It's Roughly speaking, it's a measure of how often the fund trades in its own portfolio.
So like 100% would mean that if they manage,
Everything.
$100 million, they're doing $100 million of trades every year.
More or less, yes. Yeah. That's about right. So basically, whatever they start with on January 1st in their portfolio, it'll be completely replaced by 100% of that will be replaced at the end of the year.
Wow.
Yep.
50% turnover means half of it will replace, or on average, they're holding a stock for 6 months. 50% turnover means they're holding it on average for 2 years. 100% means they're holding it on everything for an average of 1 year. 200% turnover means they're holding the average stock is hold for 6 months. Yeah. So for every 100 percentage points of turnover, a large cap fund loses on average 41 basis points, or 0.41%.
Wow.
Annual return. Average. Some are going to do better than others, but that's the average.
So then I've even seen some personal fund reports that you get into international and international small cap, and some of those trading costs are like the fully disclosed costs are 150 or 200 basis points higher than what's disclosed on the prospectus, which is already kind of high just because of the specific asset class they're trying to squeeze return out of.
That's right. I found that the large cap U.S. stocks lose about 41 basis points for 100% of turnover. For international stocks, it's like a little over 80 basis points per 100%.
So a 200 basis point turnover small cap international fund can really rack up all this additional drag on the investment. Do your sorry, Cory, I've got one more question. Does your tool do anything to assess cash drag for the mutual funds that keep a certain amount of money in cash, but because they have so many individual investors flocking to their portfolios, they have to keep a lot of money in cash for redemptions?
Yeah, that's not something we currently look at. That's a great idea for future, but that's not something we currently look at.
That's just one more, add that to my answers for our customer feedback survey. So, Dr. Sharkansky, what we're talking about now, it sounds like what I was reading in the research paper that you recently put out on your site to support the trading cost data that you have. And it sounded like, so I want to ask this in the way that lets you deliver the punchline. I'll see if I can. So there's a correlation between turnover and performance in general that seems to be negative, meaning the greater the turnover, on average, the lower the performance, especially against the index that these managers are trying to compare to.
Right.
But you also found a major lack of correlation that most people might be familiar with, but just take for granted, that you've actually proved. Would you deliver the line for us? Because you did the work.
Yeah, well, that's a great question. So in all the disclosures for mutual funds or other investment products, there's little tiny print. It says past performance does not guarantee future results.
Mm-hmm.
Yes,
something to that effect. Well, in fact, not only does it not guarantee, but there's no correlation between past performance and future performance. No correlation of any kind.
Whoa. So I just want you to repeat that again. In case one of our listeners was just at the gym in a Tabata drill, they just finished sprinting, they're breathing heavily right now.
They had to break in a crosswalk for a turtle.
They had to yell at their child who's, getting ready to play with markers on their new white living room walls. Because people are listening to this everywhere, I want everybody to pause and hear that last bit again. Say it again for us, Doctor.
There is no correlation between past performance and future performance.
None. Now that was groundbreaking for me. It wasn't until I first started reading academic research and then found dimensional funds that anybody had ever posed it that way. In fact, the way the sales training in the industry that I was exposed to early on in my career said was, well, past performance is no indicator of future, but it's the best indicator we got. Let's look at these Morningstar reports. And that was that. And that's something that maybe some of your advisors have actually said to you. And that 5-star Morningstar fund, because it had a good last 5 years worth of returns, is not, past performance is no guarantee of future. Said further, it's not correlated whatsoever, past performance with future performance.
Right. There's just no information in past performance. I mean, if you look at, for asset classes, there is information. We've known through decades of study that stocks over the long run are almost certainly going to have higher returns than bonds.
Yep.
Certainly that's the way that it's been. So we can probably count on that, the whole science of you take more risk by owning stocks so you have future returns. However, but if you look at a specific fund relative to the index of the market that it's in, then there's no predictive value in the relative performance of a fund relative to its index. So if you have a fund which is large cap US stock, the closest index being, pick your favorite one, S&P 500 or Russell 1000 or whichever one you choose, the performance of that fund relative to that index is completely unpredictable.
Some might even say random. So,
random.
Cory, I just feel inspired in this conversation today. So I'm going, we didn't talk about it ahead of time. I'm going to do a little bit of a giveaway. All
right, let me take down.
Brace yourself. Open up your Excel spreadsheet where you put all my projects. At least he puts them in a spreadsheet now instead of throwing them in the garbage. But for all of you listening, here's what we want to do to just kind of celebrate Dr. Sharkansky being on, and especially for us, because out in the marketplace, advisors are not talking about this. And sometimes, and a big reason why we do the podcast is to get these ideas and new ways of thinking your hand that are not going to come when you're watching CNN Money or Fox Business and the mutual fund companies are just laying out over and over again, their returns. And for those of you that have listened rigorously to our podcast, the returns of the funds that they let survive, that they promote, but they don't talk about these internal costs, drags, and they certainly don't, when they tout their returns, they tout the amount of stars they have, they're not discussing that it is totally uncorrelated with future performance. So if you want, like you have funds in your portfolio right now, if what you'd like to do, one, you can go to personalfund.com, navigate it yourself, work to make some sense out of it, and it's a great tool. But if what you'd like is to have our team run that and then have a short conversation with you about those, you can just send either a basket of some of the ticker symbols of your mutual funds or just send us the name. And Cory will personally run your personalfund.com report.
Oh, that's...
Yep. And just jump on the call with you for 10 or 15 minutes.
Typing into the...
Jordan, just go ahead and mute Cory for this part.
Okay.
while I'm committing his time to our audience, but in all seriousness, we'll get you that. We can also send you that research paper that Dr. Sharkansky just talked about, and you can find out more at personalfund.com. Doctor, I am so thankful that you'd be here, but I'm even more thankful that your tool exists. As Cory said, we've been using your tool for a little over half a decade. And making these things make sense to clients and giving us that scholarly third party that we can point to, because the mutual fund voices and that entire complex is so loud in our clients' lives. And I think it clouds people's perspective on the market. And I'm just super thankful, and I know I speak for Cory as well, that you would have taken the time, effort, and energy to build this tool and get it out to an audience as broad as every mutual fund owner in the United States. So thank you again.
Well, thank you very much, gentlemen. Cory and Paul, it was a delight to speak with you, and thank you for your kind words. It really makes me feel very good about what I'm doing, that it's making such an important difference for you and your clients. I really appreciate that.
Yeah, you're welcome. And
Great.
for all of you listening, as always, I encourage you, take some time. This podcast is valuable to you. Send it to somebody you know. Text it to the HR manager at your work. They should know about this for your 401k. Send it to a friend and have a conversation about money. People are constantly, over and over again, saying they want to be great at two things: sex and money. Now, I don't know how to tell you to talk to your friends about sex, but it does make sense to have some conversations about money that just aren't about what kind of lease deal you got on the new car or what your mortgage rate is, but really the things that we need to do to be good stewards of the capital that we have, to build the future that we want, to build definite financial independence so that you can fund your work optional lifestyle. And as always, Cory and I hope that this has been a contribution to you being able to design and build a good life. Hey everyone, hope you enjoyed watching that video, tuning in. We love having you guys here. Don't forget to like that video, subscribe, and hit the alert bell. But by the way, if you just have questions and you want to dig in and learn a little more, go ahead and email us at info@sfgwa.com. Put yourself in the position to have a 15-minute phone call. I mean, come on. Can your current plans withstand a second opinion? If not, that might be the very reason to reach out.